Hey there, this is Tracie Schmidt with the Schmidt team at Supreme Lending, and we are having a team meeting with the amazing Patti Gregory and her team. Patti, how are you?
I'm good. How's everybody?
I love your backdrop. It's like, it
I
makes
took that picture myself. Isn't it beautiful? Laguna's so pretty.
it's so gorgeous. So Patti, just want to do a quick introduction.
I'm Patti Gregory with the Haven Realty Group, and Diana and Mary are two members of our team, partners on our team. And we're talking today about the elephant in the room. Everybody's freaking out about interest rates, and everybody kind of needs to take a breath.
Yeah.
So we're hoping to, be the calm in the storm right now and get people what they need to know.
Yes. And a quick introduction, because I'm going to let her get off the phone so she doesn't hurt herself driving. But on the call also, we have Stephanie. Stephanie, you want to wave hi? So Stephanie's a loan officer on my team as well. So what we really try to do is make sure that, Patti's clients have support at all times, right? So if one person's not available, it's a team effort, right? We're working on the behalf of your buyers or your sellers and just making sure that we're giving them the best information as possible and the best service as possible. So Steph, if you have to log off, you're absolutely welcome to. I'm going to share my screen and just get into the video portion of it really quick.
Awesome.
And so let's see here. Okay.
Got it.
All right. So I need to share screen two, and then let me minimize this. Okay, great. So let me show taskbar, get all you guys back up here. Okay. So we are going to talk about a couple of different things, but this is how I feel like we kind of all feel right now. Right?
100%.
Yeah, we're like suiting up. We're trying to figure out like, what do we do? Who are we charging at? What's happening? So I thought that was quite funny that we're just kind of going into like this war, right? Of just trying to figure things out. So I wanted to give a recap of the last 14 days and kind of what's happened so you get an understanding of it. So on Friday, June 10th, a CPI report came out that measures inflation. Okay. Inflation rose up to 8.3%. Now, the comfortable inflation rate is 2 to 4%. So clearly, when that report came out, it was way higher than what anybody anticipated or wanted to see. So what happened is we got a rate increase as mortgage lenders on June 10th, June 13th, and then June 14th was the largest single day rate increase since 1979. And that's the day that it went up 0.5% in addition to those other 2 days. So that week, I tell you, that was last week, last week, it was not a fun week for us. And we did feel like those people in the suits. So the Fed really has one tool to battle inflation, right? And that's to just raise rates. So even though inflation is caused by the global economy, our economy, COVID, the stimulus, all of that stuff, what they really have the ability to do is raise interest rates to battle inflation. Okay. So the Fed met on June 15th. They raised the federal funds rate or the federal interest rate by 0.75%. So when people hear that, they think that mortgage rates went up 0.75% because of that. Now, that Fed funds rate does not directly affect mortgage rates. Okay.
Hadn't the mortgage rates already gone up before in anticipation?
Exactly. So yeah. It like went up the same amount at the same time, right? But what the Fed funds rate changes is equity lines, credit cards, student loans, car loans. So those interest rates are also going up, which are putting pressure on households, right? The groceries are going up, gas is going up. So they're seeing an increase in all of those expenses. So what we want to really go through is the erosion of purchasing power, right? So, and this isn't meant to be negative. It's just the reality right now that we're in that we can share with people. It's kind of a good thing to show buyers like, hey, if you wait, this is what could happen to your purchasing power. Now, when I say purchasing power, that means the loan amount that they were going to get at this time. And we're basing it on just a principal and interest payment. So $4,000 a month, just to make it easy. Okay. So in January, their loan could have been $922,591. Okay. At a 3.22% approximate rate. You fast forward only 5 months and 10 days later, that loan amount drops down to $648,278.
That's just crazy. And we've tried to tell buyers, this was, yeah,
Could
and it's
happen.
just, yeah.
So if they wanted that same loan amount today, the payment would be about, figured out, like a little over $2,000 a month higher. And that's just waiting 5 months, right? So what we're trying to stress to people is, if you want to buy a home, let's figure out your affordability. Let's figure out if you can afford that payment, because you just don't want another 5 months or 6 months or a year to go by. And it's just changing again on you, right? And lowering the sales price that you could purchase.
Where do you see rates going in the next 6 months?
So they're telling us to give kind of that projection of what they're hearing. There's another Fed meeting that's coming out in July. Their Fed meeting, they're saying that they're probably going to raise that federal funds rate by 0.5%, which again changes all of those other things. So they're saying projecting to get to about 7% by the end of the year.
Okay.
Yeah. So net worthless. So what also is happening is people's down payments are being eroded, right? Because you have your money in the stock market, the NASDAQ, the 10-year treasury, right? These things are taking hits as well. So what we really just want to be cognizant of people is like, hey, if you have money in retirement, right, and you're looking to purchase a home, maybe investing in a home that's going to earn you appreciation versus losing that dollar in the market, right?
Even with a correction in the market, which is coming,
Absolutely.
in 5 years, you're still going to be up higher than you are today.
Yeah, and honestly, the person that shared this presentation with me, her thing is, you marry the house, you date the rate, right? So like,
there you go, because rates are probably likely going to come back down. Well, that was one of my questions.
Yeah.
Will they follow inflation as inflation comes down?
The projection is for rates. I mean, 2%. No one ever thought it would ever get
to
2%.
No, but anyway. Normal maybe 4 or 5.
But more normalized, yes. So like back to about a 5% range. And that's what's going to cause.
People forgot is normal.
Yes, and that's why I wanted to show the next slide, right? So you could see, 2021 obviously wasn't normal. 2010 was 4.69. So we're going back to, the rate that we were at. We're at about 19, where are we? 6.5%, about 2002. So 20 years ago, right? This is kind of where we are now in the market. So they project, like, they think once everything corrects itself, probably more around the 5% range, which is for people now, even if you're getting in at 6.5 or so, you're going to still get appreciation built, and you could refinance down the road because you'll have some of that equity. So I think that was good to show people. I mean, if we go back in the day, right? I mean, 16%, 10%, we still had an economy. We still had a market. We still had real estate. We still had people owning homes. I just think that people kind of forget because of everything recently that's happened. I don't know if you agree with that, Patti.
Totally agree.
Yeah.
When I was in high school, my parents bought a house at like 16%.
Yeah. And they didn't stay in that house forever, right? I mean, you refi. When the rate went down to 12, they probably pulled some cash out. And what I try to put in perspective also is, people are paying 23% annually on a credit card that's revolving, right? And some have $20,000 balances that you're going to have for your life, probably. So interest rate, it's a mindset, in my opinion. It's all about payment and affordability, right? That's what I try to just explain to people.
Exactly. And it's all fluid. It's going to change. They're going to go up. They're going to go down.
Yes.
And you just try to do your best. I don't want to say time the market. Yeah. But when they come down, you refi.
What's the interest rate on rent? 100%.
Exactly. Yeah. I mean, you're not gaining anything in that instance.
Right.
And rents are increasing also.
Oh yeah, definitely.
Rents are through the roof right now.
Yeah. And this is a really good information to share with your sellers, because when buyers and sellers work together in this market, we all win. And this is why it's so important to have a real estate agent like Patti and her team, and a mortgage lender like myself that's been in it. I was in the 2008 crash. And we have to work together to be strategic with our buyers and our sellers to make sure that we're not doing things that could hurt them, right? So for example,
100%.
So for example, what we think is going to happen is prices are going to start to come down, or sellers are going to have to start reduce pricing, right? Well, what we're saying is, hey, if you have a $750,000 house, right? Instead of reducing the price 45 grand, instead give a $45,000 seller credit because you can give up to 6% of that sales price on certain programs. Okay. What that does for the client is it keeps the sales price the same. You're going to net the same amount, but it allows the client to buy down the interest rate a little over 1%, right? Get a lower monthly payment so they could actually afford to buy your house. And overall come in with the same exact amount of money or even a little less, right?
Now I'm seeing this loan program is getting a lot of love right now, but we have to get with you when we're writing the contract, correct?
This isn't even a loan program. This is like when you have an owner
strategy.
The strategy, exactly. So credits cannot exceed costs. Okay. So in this example, closing costs would be about $15,000. So what we're doing is we're using the rest of that $30,000 credit to discount the interest rate with discount points. And it's not considered a high cost loan because the buyer's not paying it, right? It's being offset by a seller credit. So absolutely. So if you were a listing agent and you're like, hey, let's strategically figure out how to market this property, and you have a buyer that you're working with, this is what we would figure out. I would say to you, like, hey, Mr. Buyer, if you can get a credit for 30 grand, I can get your rate to this and your payment to this. This is how much you would bring in, and then let you know as the listing agent. So
yeah, this is really smart.
So this is important.
Look at the difference in that payment.
Yeah, they're going to get a lower payment, a lower rate. And it's a way for sellers to when inventory increases, right? And there's more competition, instead of dropping your price, offer a credit.
Let's make it more affordable.
Yes, absolutely.
Yeah, I like it.
It's a way to kind of work the system. And I'm almost done. But what we love about this market, because we want to stay positive, right? If we dug our head in the sand and we just listened to the news, we would all be out of business at this point.
We're the opposite of that. I'm only
too.
listening to what I have to stay current. But
Me
yeah,
too.
this is a good time for buyers, because my sellers that were afraid to sell, and I had an ad running, you won't be living in a tent, will be able to find their replacement home.
Absolutely. So, and these are some points, right? So, hey, buyers, there's less competition. You can actually do a contingency purchase now, where
we're back to contingency.
You were waiving everything, Mr. Buyer, right? So now you have a little bit more protection.
Yes.
Yeah. Now you can ask for a closing cost credit, where before it was like, heck no. If your offer had a closing cost credit, you were like out of the mix,
the trash,
right?
Yeah.
There's more inventory to choose from. And honestly, the prices are dropping. If you look at percentages in your market, Patti, which I'm sure you do, right?
Yes.
Things are not selling as often over list, right?
Well, I think the ones that didn't get on the bandwagon when they should have, they're overpriced. And that's what we're seeing come down.
Yeah. So same thing, because the appraisals are still being supported, right? So you going back to that person and saying, hey, let's do this strategy instead. Or maybe you go to a seller that has their house on the market for 60 days and say, hey, I have a strategy that might help you sell your home, right? So there's different things. For sellers, it's positive. Now they could probably ask for a rent back and get it, right? They're still making money. The values are still being supported, so they could give that closing cost credit, and they have options other than price reductions. So there is still win-wins for each side. And lastly, it's like now more than ever, right? You need a mortgage lender, you need a real estate agent, where we kind of wear that cape. And she used this example of someone comforting them. It's like, okay, I'm comforting the buyer, you're comforting the buyer, you're comforting the seller, I'm comforting you, you're comforting your team.
And we're going to get them through the process.
Absolutely. And we're the ones in the cape. And it's like when we just team up and we're like, we're going for it and we're there for our clients, I think that it could still be a win in this market.
I love it.
Good. Well, that's
always
all I
the
have.
goal.
Yeah.
I have one question. What are ARMs looking like right now?
So when you're doing like a conventional product, like an agency product, they're slightly lower than the 30-year fixed. So I would probably say the last time I priced it, you're probably about 3/8 lower.
Okay, not that much.
Yeah, so that's good. And again, that buy down is so important, because with the mortgage-backed securities and everything that's happening, the rate interest rates, like the coupon rates, there's a cost now to get lower rates, right? There's a bigger cost. And because you can't go over a certain cost to a buyer because it's high cost limits, that's where that credit really comes in to help, because you can still buy down the rate, pay the discount points, and have the seller pay it instead of the buyer.
Okay, one last question.
Yes.
What's it looking like for my investors and my short-term rental people on their loans?
Yeah, I love that product. I mean, we're still pushing it. 3-month bank statement, 12-month bank statement, 24-month bank statement, DCSR. There's the investors that you want to purchase a home like an Airbnb, a Verbo, a multi-unit. You want to use investment income. No, we don't need any other income. You have to be an investor, no job, no income verification.
Okay. And what's that interest rate look like this week?
Higher. I mean, I would say, honestly,
8, 9?
I don't price them every day, but yeah, I mean, they were like in the low 8s.
Okay.
And they have options too on different types of loans. Like generally those investor loans will come with a standard prepayment penalty because it's an investment property. They have the option to buy that out, right?
Okay.
And they can buy it down. So those would be add-ons. So I have a really like cool calculator that when I know that scenario, I plug it in and it gives me, gives me the interest rate and all of that stuff that I could easily quote someone.
Because there's like never been a better time right now than to buy income property.
Yeah. And you know what? People can buy in LLCs, right? Corporations are being smart and buying real estate.
Can a corporation get the loan? Can the corporation be okay? Good.
Yeah, there's certain products that you can buy as an LLC. Yes, not your standard, Fannie Freddie agency loans,
right?
But the non-QM loans, yes, it could be
okay. Good.
An LLC.
Yeah. That's a lot of information packed into a short time. I was
like,
love it.
Fire hose. So I want to just be a resource to you guys. Let me know. I'm gonna stop the recording really quick.